Imagine working 100-hour weeks, surviving on anxiety, caffeine, most likely other substances, all for the chance to make millions. Welcome to the world of investment banking, where sleep is optional, Excel is your best friend, and your paycheck can look like a phone number. But here's the real question. How do these bankers actually make money? Are they just moving numbers around on a screen and hoping for the best? Kinda, but not really. These guys are deal makers, the financial middlemen who grease the wheels of capitalism. Whether it's taking a company public, brokering billion-dollar mergers, or making CEOs even richer, investment bankers take their cut, and sometimes a very, very large cut. And that's where things get interesting, because while the junior analyst is pulling all-nighters for a six-figure salary, the guys at the top of the food chain, the managing directors, are making millions from a single deal. But before you start dusting off your resume and buying a navy blue suit, let's break it down. What exactly do investment bankers do? How do they get paid? And is it really worth selling your soul to Wall Street? Stick around because we're diving into the money, the madness, and the million-dollar bonuses of investment banking. So before we talk about how investment bankers make money, let's clear up a major misconception. These guys are not stock traders. They're not sitting in front of 20 monitors yelling buy or sell. That's a different department. Investment bankers are the ones who structure the big deals, the mergers, acquisitions, and IPOs that make headlines and move markets. Think of them as the corporate matchmakers. Their job is to connect businesses with money, whether that means helping a company go public, raising funds for a massive expansion, or advising a CEO on whether to buy out a competitor. They've got four big main responsibilities. The first is mergers and acquisitions, or M&A for short. Let's say company A wants to buy company B. Investment bankers make that happen, negotiating, valuing businesses, and taking a nice, juicy fee in the process. They also take companies public through initial public offerings, or IPOs, which is when a company will sell shares of their stock on the public stock market for the very first time. Investment bankers are the ones who set this up, deciding how much those shares should be worth and taking a cut of every dollar raised. The third thing they handle is debt and equity financing. Sometimes companies don't want to go public, but still need money. Investment bankers help them raise cash by issuing bonds, also known as debt, or selling shares, which is equity. The bank gets a fee, the company gets money, and everyone wins. The last of their major responsibilities is financial advisory. They act as a high-priced consultant. A CEO wants to know whether expanding into Europe is a good idea. Bankers crunch the numbers, make fancy PowerPoint slides, and charge a fortune for their advice. Now, you might be wondering, why don't companies just do this themselves? Well, the stakes are high. We're talking billion-dollar deals, and one bad decision can wipe out a company overnight. Investment bankers are the experts who make sure things don't go horribly wrong, most of the time. So, now that we know what they do, let's get to the good part. How much money are they actually making? Even at the lowest levels, investment bankers are making solid six-figure salaries. And at this stage of their career, they're pretty much just PowerPoint and Excel monkeys. Here's a rough breakdown. An analyst, which is the entry-level position, will probably earn somewhere between $100,000 to $150,000. An associate, who's been in the industry for a couple of years, probably somewhere around $150,000 to $250,000. A vice president, who acts as a mid-level manager, will earn anywhere between $250,000 to $400,000. And the big dog, the managing director, will earn somewhere in the range of $400,000 to $1 million a year. Not bad, right? But here's the kicker. These are just the salaries, the starting points. The real money in investment banking comes in the form of bonuses. Investment banking bonuses can be anywhere from 50 to 200% of your base salary. That means a first-year analyst making $120,000 could take home another $100,000 in bonuses alone. And at the higher levels, we're talking seven-figure bonuses. So what determines the bonus? One aspect is individual performance. Did you work 100-hour weeks and make zero mistakes? Congrats, you might get a fat bonus. The second is deal flow. If the bank made billions in fees that year, the bonuses will reflect that. If the market crashed, better luck next year. The third is firm performance. Even if you personally killed it, if your bank had a bad year, your bonus will probably take a hit. And just like in most industries, there's always the ever-important aspect of ass kissing. If your managing director or VP doesn't like you, you're getting bonus diddly squat. It's important to note that bonuses are also where compensation can oftentimes seem pretty unfair. A managing director who happens to close one massive deal could be looking at a $5 million plus bonus, while the analyst who grinded all year on that same deal might just get a pat on the back and a slightly bigger paycheck, which is why everyone is trying to make it to MD. Okay, but where does all this money actually come from? Simple. Investment banks charge huge fees for handling billion-dollar deals, and by huge, I mean millions per deal. On M&A deals, banks will typically take 1 to 2% of the total deal value. So if a company buys another for $10 billion, banks' fees could be $100 to $200 million just for making the introductions and running some spreadsheets. For IPOs, the banks will take a cut of the total money raised, usually around 5 to 7%. So if a company raises $1 billion in an IPO, the bank might walk away with 50 to 70 million in fees. For debt and equity financing, again, they'll take a 0.5% to 1% on total funds raised. So all these fees trickle down into those massive bonuses we just talked about. So the more deals a banker closes, the bigger their payday. So to sum it up, investment bankers get a solid salary just for showing up, insane bonuses if their firm makes money, and the bank itself rakes in millions from handling major deals. It's a brutal job, but if you can survive it, the money is life-changing. But before you start Googling how to become an investment banker, let's talk about the dark side. Because the job isn't all about fat paychecks and fancy suits. Burnout rate is sky high. The stress is brutal. And the hours? Well, let's just say you won't be seeing your friends much. You know how most people work a 9 to 5? Well, investment bankers work more like 9 till 2 a.m. every single day. 80 to 100-hour work weeks, literally what people like Elon Musk have to do, are standard, especially for analysts and associates. Weekend plans? Forget about it. You're on call 24/7, and a last-minute deal could ruin any hope of free time. Oh, you love sleeping? No, you don't. In fact, there will 100% be nights that you don't even go home, and will probably sleep under your desk. No joke. Go Google investment banking nap rooms. Imagine working on $1 billion merger or multi-billion dollar IPO, where quite literally a single mistake in an Excel formula could cost the firm millions. That's the kind of pressure we're talking about. Junior analysts are expected to triple check everything because a typo in a financial model could get you screamed at in front of an entire team. Oh, and your managing director will not hesitate to call you at 2 a.m. to fix a minor issue in a 200-slide PowerPoint presentation. To put it succinctly, it's a sink or swim environment. If you can't handle the stress, they'll find someone who can. You'd think that after working 100-hour weeks, bankers would at least have job security. Nope. If the market crashes, you will get laid off. And quickly. When deal flow dries up, banks cut costs by firing people. Sometimes entire teams get wiped out. Same things happen in a bad market. Lower bonuses, smaller paychecks, and mass layoffs. And even if you survive the layoffs, a bad bonus year could make you realize that your hourly wage, after factoring in the insane hours, is not much better than a Starbucks barista. The human body was not designed to live off caffeine, anxiety, and 4 hours of sleep. But investment bankers try anyway. Burnout is inevitable. Most analysts quit within 2 to 3 years because the workload is unsustainable. Mental health takes a massive hit. The stress, isolation, and lack of sleep can lead to anxiety, depression, and even substance abuse. Physical health suffers too. Eating at your desk, no time to exercise, and constant stress equals high blood pressure and no hair by the time you turn 30. So yeah, investment banking pays insanely well, but it also demands your soul in return. And the burnout rate is sky high. It's not a career, it's an endurance test. The real question is it worth it? Some people grind through the years making a ton of money, and then escape to a cushy finance job with better hours. Others burn out, quit, and never want to look at an Excel spreadsheet ever again. So let's talk about what happens after investment banking. Where do these people go, and what's the real path to long-term success? This is the most common exit route for ex-bankers who still want to make insane money, but with slightly better hours. Private equity firms buy and sell companies, using investment banking skills to turn struggling businesses into cash cows. The hours are better, think 60 to 80 hours instead of 100, and the pay is even higher. Top private equity firms offer salaries of $300K plus bonuses. For instance, have you ever heard of Blackstone or KKR? These firms make billions buying companies, fixing them up, and selling them for a profit. And guess who they love to hire? Ex-investment bankers. If you'd rather place billion-dollar bets rather than negotiate billion-dollar deals, then hedge funds might be your move. They make money by betting on stocks, currencies, and entire economies with their own and outside capital. Investment bankers who are great in numbers and strategy can land high-paying jobs in research roles or as analysts at hedge funds. And the best hedge fund managers make insane money, as in billions each year. The downside, if your trade fails, you're out. The industry quite literally has zero patience for losing money. This is the I want a life route. If you've had enough of the 2 a.m. emails and want something more stable, then corporate finance is usually the career path chosen. They'll often transition into CFO roles at Fortune 500 companies, where the hours are more normal, the pay is still great, and you actually have free time. This one's for the bankers who are sick of working in soulless finance and decide to actually build something for themselves. Some start their own businesses, others become venture capitalists, investing in tech startups and riding the next billion-dollar wave. For example, ever heard of Chamath Palihapitiya from the All In Pod? He started in finance, then moved to tech, and was an early employee at Facebook, then ran a couple of VC firms, and now is worth billions. So, while investment banking is brutal, it opens doors to some of the most lucrative careers in the world. Ex-bankers rarely end up broke. The real question is, are the years of stress, exhaustion, and non-stop work worth the payout? Some say yes, some say no. But at the end of the day, that's for you to decide. So now I want to hear from you. Would you take a high-paying job if it meant working 100 hours a week? Or would you rather make less money and actually enjoy your life? Drop a comment below. And if you like this breakdown, hit that like button. And subscribe if you want more deep dives into how different careers make money. Because next time we're looking at hedge fund managers, the guys who make insane money while working way fewer hours. You don't want to miss it. Thanks for watching, and I'll see you in the next one.